Are we going to get the first rate hike in 4.5 years? The Reserve Bank of India's Monetary Policy Committee deliberates on this issue Monday through Wednesday and announces their decision on Wednesday. But CNBC TV 18 Citizens Monetary Policy Committee is here with me right now to deliberate what they think are the underlying inflationary forces and growth impulses, and hence what the vote ought to be. Joining me now are Chairman of the Citizens Monetary Policy Committee, Dr. Pranab Sen, former advisor to the Planning Commission and former Chief Statistician, Sajid Chinoy, the Chief Economist from JP Morgan, Sonal Verma, the Chief Economist from Nomura, Shaumya Kanti Ghosh, Chief Economic Advisor, State Bank of India, and Shaviran Chakraborty, the Economist from Citi. Gentlemen and lady, thank you very much for joining me. First up, Dr. Sen, what are the growth and inflation impulses that you would monitor before you take a rate decision?
Well, I think with yesterday's GDP numbers out, I think we've got a little more clarity as to what's going on. So let's start with the inflation part of the thing. The inflation story is starting to look really dangerous now. Core inflation continues to work upwards. We are coming into the Kharif season, which is principally a rice growing season. And if the 50% plus MSP is announced, that's going to add another maybe, the rice MSP will go up by about 17 to 18%. So that's going to add another impetus. The rupee is weakening, the oil stays up. So all of those add up to, I think, strong inflation challenges. Yesterday's figure on the GDP was interesting because it came in, I think, stronger than expectations. But much of it is driven by government expenditures. So now if one looks forward on the growth front, next year the downside is that government cannot maintain this pace of growth of its expenditure. It's going to come down sharply. This would have been okay if it had been only on the consumption expenditure side. But the problem is that a lot of the investment numbers we are seeing is also driven by public expenditure. And we still don't have an indication whether private investments have really started to respond. My sense is that it hasn't. So we are looking at a mixed picture for next year. Of course, the other positive is that the global economy is growing. There is coordinated recovery across the world, and hopefully we should be able to tap into it, particularly with a weaker rupee and some of the GST problems having gotten sorted out. So we've got a mixed bag. But, at the moment, I think the real trade-off is almost certain inflation and a somewhat questionable growth.
Okay, somewhat questionable growth. The other big, of course, element which the Reserve Bank will have to take into consideration would be what's happening on the currency front across emerging market currencies. Sonal, from your perch in Singapore, would that be a compelling reason to give a boost to the rupee, or at least keep it stable, the reasons for a rate hike?
Yeah, Latha, I think from a purely inflation perspective, average headline inflation, excluding the HRA impact in FY19, may still be around 4.5%. So at 6% repo rate, there's still a 1.5 percentage point real rate cushion. But clearly, the global environment has completely changed in the last couple of months, given the increase we've seen in oil prices, along with the stronger dollar, US interest rates moving up, and across emerging markets, we've seen pressures come back on the balance of payment front. So, I think from an inflation targeting perspective itself, the changing global environment clearly means an upside risk to the inflation outlook. But purely from a macro stability perspective, this has become quite important. So we have, of course, seen countries like Turkey, Argentina, even Indonesia, which has delivered a preemptive rate hike, and India, with its twin deficit, also needs to ensure that macro stability remains a priority. So I would say yes, from an external and changing global dynamics perspective. But if you superimpose even the domestic changing growth inflation dynamics, both the things actually point to the same direction, which is that there is a need for the monetary policy cycle to now turn.
Okay. Well, Soumya, would you want to add to that? Is the global scenario indicating that there is a need for India to step up with a rate hike?
See, before I get into the global part, just very quickly a point which the chairman said in terms of the data released yesterday. I think the GDP numbers data released yesterday has some very positive surprises, but beneath the numbers there are two things which needs immediate attention. The first thing is that the nominal GDP growth rate has now declined to below 10%. Yes. I think that is possibly the first time in decades. The second thing is that the consumption expenditure continues to be lower, and it is coming on top of a lower base last year. And the other thing is that if you actually look into the per capita PFC, that has actually decelerated, indicating that there is a negative income drop across decile groups. So that's a point of consideration. That's mostly because of the agricultural GVA deflator is significant on the lower side. So that's one thing. So the nominal agriculture is not picking up. So there is some uncertainty on the domestic growth front. If you go into the global growth front, I think even after all the talks about the synchronous growth recovery, I think there is now an element of an asynchronous global growth across the world. For example, Japan has shrunk for the first time after 8 quarters. Then if you look into the data of Italy, which happened in a couple of days back, I think a lot of these banks like Spain, Germany has a lot of exposure to the Italian debt, so that's going to have a negative impact. The other thing is that if you look into the emerging economies purchasing PMI index, that has declined to a 16-month low if you look into the export component. And the Korea and the Chinese export orders are actually at 10-month lows. So these are some numbers which we have to take consideration. And the other thing is that very interestingly, just after these Italian crises, if you derive the probability from the Fed future rate, that has significantly declined to below 50% for September. So while we may be sure for a June rate hike, I am not sure about a Fed rate hike in September. And also the wage growth at 2.7% of USA is still lower than what it was in the pre-crisis period. So
global growth is not a given.
Not a given at this point of time. There is a lot of uncertainty on the global growth and also the domestic growth. So if I take all these factors into consideration, I think the central bank needs to take into account these things before taking a call.
Definitely important. Continuing with what Dr. Sen said, Indian growth could have some weak soft spots despite the very good headline number for the 4th quarter, and global growth question marks. I think George Soros also raised that issue very prominently. Shamiran, the uncovered topics which although everyone has spoken about it obliquely, fiscal problems, loan waivers, election season, and of course MSP. All this would mean probably fiscal looseness and therefore the monetary tightness warranted?
Well, the way I kind of loosely put it is that you are seeing a situation of relatively higher inflation, particularly core inflation. You're seeing a situation where headline growth is high, and even taking into account Chairman's point about the growth being driven more by government, less by private, it all adds up to aggregate demand. So there is an aggregate demand push. There is a somewhat weakening currency, and there is a somewhat loosening risk of a fiscal. So this combination of high growth, high inflation, loose fiscal and weaker currency, in our view, has to be combated to some extent by a tighter monetary policy. Otherwise, you might soon lose the equilibrium path completely. So that's where I guess we'll have to start tracking now that how the fiscal risks from MSP, oil excise duty cut, or GST, how these three particularly pans out to figure out that to what extent we will require somewhat of a tighter monetary policy to combat that.
Okay, I'll come back to you whether this merits only a change in stance or whether this actually merits a change in policy action, because, I mean, as the chairman and Soumya are pointing out, there are soft spots in growth, both domestically and globally. But Sajid, you know, we all talk about fiscal looseness and loan waivers. To be fair, the government has kept somewhat to the trajectory, and the fiscal numbers have indicated that FY18 is 3.5%. So, lived by the letter, you will have to say. Can you, presage that there will be fiscal looseness, and is monetary tightness called for just yet?
No, you can't presage that, I think, because I think for the most part the government's been very responsible on the fiscal front. Even the last few weeks, the big pressure to cut excise duties, they've not bucked to that pressure, and they've been very responsible. I think I agree with Dr. Sen here that I think both for the reasons he mentioned and Soumya mentioned, we should not take strong Indian growth and global growth as a given. Given that monetary conditions have tightened in India the last 6 months, oil prices are 30% higher than last year, and you're undergoing a deleveraging process, I think at best we get a limited pickup, number one. Number two, we're seeing some slippage in European growth in the second quarter, and the stronger US dollar that results from that is going to have some feedback loop on US growth, US inflation, and therefore how the Fed acts. So lots of moving pieces. But let me just say this. I think the beauty of a flexible inflation targeting framework is that it imparts some predictability to the process. So far, the RBI has been saying our policy decision will be guided by where inflation is 1 year ahead. Now, purely from a cost push perspective, higher oil prices, a weaker currency, higher food prices that are imminent, and the fact that there's stronger pricing power, as witnessed in the core inflation numbers, we can, with reasonable confidence, forecast that on an as-is, where-is basis, 1 year ahead inflation will be about 5%. If your medium-term target is 4%, it's an early inflation targeting regime, your forecast is 5%, that should be enough for the RBI to tighten monetary policy, even if there is not so much conviction on domestic growth and global growth, growing gangbusters. And that's the sense, I think, that's the reason we believe that, some tightening is on the anvil in the coming months. Whether it's June or August, I think, is less important.
Okay. Well, gentlemen, we have to take a break on that note. But remember the pointers that both Deputy Governor Viralacharya and Governor Urjit Patel put into the minutes. I mean, they said they are monitoring crude, they said they are monitoring core inflation, and they were also worried about fiscal impulses. So I want a little more of analysis of how these things have progressed from the April policy, and therefore how would this Monetary Policy Committee like to vote? We are back in a jiffy.